What if you could invest in 3 Singapore brands that pay you 5 to 6% yearly, hold more cash than debt, and still fly under the radar? No hype, no crypto, no tech, just stable, cash-rich businesses that feed millions every day. These might just be your safest dividend anchors when the next crash hits. Hey investors, welcome to Durian Finance, where we decode the best income and value stocks across Singapore and Asia. In today's video, we're revealing the top 3 recession-resistant dividend stocks on the SGX. QAF, the bread and dairy giant behind Gardenia. Kimley, the coffee shop landlord with steady payouts. PSC Corporation, a hidden FMCG gem with more cash than market cap. We'll break down their financial stability, growth plans, and end with a head-to-head comparison, so you'll know which stock fits your portfolio. Let's jump in. Disclaimer: this video is for educational and informational purposes only. It does not constitute financial advice. Please do your own research or consult a licensed advisor before investing. First up, QAF. You probably know them as the makers of Gardenia bread and Cowhead Dairy. But behind the scenes, they operate 16 factories, supply over 81,000 outlets, and dominate the bakery space across Singapore, Malaysia, and the Philippines. In FY 2024, revenue grew to 636 million Singapore dollars. Net profit surged 26% to 34.7 million Singapore dollars. EBITDA margin improved to 9.4%. What makes this stock shine? A fortress balance sheet with 177 million Singapore dollars in net cash. Debt to equity just 6.38%. PE of 14.1x. EV/EBITDA of 4.25x, and trading below book value. They even declared a 5-cent dividend, giving a 5.9% yield, very sustainable with an 83% payout ratio. They're also not standing still. QAF is expanding health-conscious products like low GI bread, vending machines, and frozen baked goods. Next, Kimley, the quiet landlord of Heartland Food. They run 86 coffee shop outlets, 191 stalls under brands like Kimley Z-Char and Tender Fresh. Business segments include stall rental, food retail, and outlet ownership. In FY 2024, revenue came in at $319.4 million, growing 1.8% year-on-year, not flashy but steady. And despite inflationary pressures, net profit held strong at $31.7 million, excluding one-off items. What really stands out is the EBITDA, nearly $92 million, giving the company a healthy EBITDA margin of over 28%. That's a solid sign of operational efficiency. Kimley also maintains a net cash position of $98.5 million, with no significant bank debt. However, lease liabilities from its outlet investments push the debt-to-equity ratio to around 70%, still very manageable for a cash-generating business. From a valuation standpoint, Kimley trades at around 12 to 13.5 times earnings and roughly 5.2 times EV to EBITDA. It's attractively priced for a defensive food player. And of course, the dividend, 2 cents per share, translates to a 6.15% tax-free yield, making it one of the highest-paying consumer staples on the SGX. Add to that a 10.4% net profit margin and a healthy current ratio of 1.12. And you've got a well-balanced business that thrives on your daily Copio and Z-Char. Third, PSC Corporation, a 50-year-old consumer goods powerhouse based in Singapore. They manufacture, distribute, and market a wide variety of everyday essentials, everything you use at home or find in hawker centers. Royal Umbrella Rice is a flagship brand, dominating Singaporean kitchens. Then there's Fortune Tofu, a staple in daily meals, and Botex tissue products, ubiquitous in households and businesses. PSC doesn't stop at food. They also operate a packaging division, supplying cartons and paper-based packaging to FMCG companies across Southeast Asia and China. In 2024, they acquired a majority stake in Kim Guan Guan Coffee, expanding their portfolio into traditional local coffee powders and beverages. On the manufacturing side, PSC is actively investing in automation and efficiency upgrades across its factories, while simultaneously deepening its e-commerce presence and expanding coffee operations into venues across ASEAN and China. In FI 2024, revenue came in at $488.6 million, up 1.4% from the previous year. Net profit rose 4.4%, reaching $22.75 million, showing resilience despite inflationary pressures. On the cash front, PSC is sitting pretty. It generated free cash flow of over $36 million and maintains a net cash position of $117.5 million after subtracting all debt. That's more cash than many SGX mid-caps. Its debt-to-equity ratio? Just 21%, which is extremely low, giving the company flexibility to invest or return value to shareholders. When it comes to valuation, PSC looks seriously undervalued. It trades at just 8.4 times earnings, an EV to EBITDA ratio of 1.42, and a price-to-book of only 0.57. In simple terms, you're buying this business for less than 60 cents on the dollar. The company also pays a steady 2 cents per share in dividends, giving investors a 5.4% yield, comfortably backed by earnings and free cash flow. And with a book value per share of 62 cents, it's currently trading well below its actual worth. To sum it up, PSC Corporation is a net cash, low-debt, stable revenue compounder that flies under the radar. Its mix of food staples, paper goods, and coffee brands makes it a quiet powerhouse, perfect for income-focused investors who value margin of safety. All right, now let's break down how these three dividend giants stack up, side by side. Starting with revenue, QAF leads the pack at $636 million, followed by PSC at $489 million, and Kimley at $319 million. But don't be fooled, size doesn't always mean stronger returns. In terms of net profit, it's a tight race. QAF edges out with $34.7 million. Kimley follows closely with $33.1 million, and PSC delivers a solid $22.8 million. All three are profitable and consistent. Now, let's talk dividends, the reason many of you are here. Kimley offers the highest yield at 6.15%, just ahead of QAF at 5.9%, and PSC at 5.3%. These are steady, sustainable yields, great for income-focused investors. When it comes to net cash, PSC leads surprisingly, with over $206 million on hand. QAF isn't far behind at $177 million, and Kimley holds a healthy $98.5 million. All three have strong balance sheets and minimal reliance on debt. Looking at PE ratios, PSC is a value play at just 8.4 times earnings, followed by Kimley at 12x and QAF at 14.1x. So PSC is the cheapest on an earnings basis. The price-to-book ratio tells a similar story. PSC is trading at a deep discount, just 0.57x book value. QAF trades below 1x as well, while Kimley is a premium player here at 2.2x, likely due to its high yield and local dominance. Now let's assess business resilience. All three rank high. They deal in food, household essentials, and services people need regardless of the economy. But Kimley and PSC stand out with very high resilience, thanks to diversified income streams and strong operating models. Lastly, the growth outlook. QAF is on a steady path. Think moderate expansion with healthy cash flow. Kimley is focused on local upgrades, halal expansion, and digital improvements. PSC, meanwhile, is looking outward with ASEAN expansion, automation, and coffee distribution in China. So here's the big picture. Choose QAF if you want established branding and cashback safety. Go with Kimley for yield, consistency, and local dominance. And pick PSC if you're hunting for deep value, high cash, and long-term upside. In uncertain markets, consumer staples with strong balance sheets and steady dividends are where smart investors take shelter. From Gardenia bread to Z-char stalls to a bowl of tofu, these businesses are built to last. So, which one are you betting on? Comment below, Team QAF Kimley or PSC. Like this video if you found it helpful. Subscribe to Durian Finance for more no-nonsense SG stock insights.